everybody, welcome to our webinar. This is a delayed recording of a webinar I was supposed to have done on Wednesday, but due to technical issues, I'm doing this a day later. But anyway, welcome to our webinar for this month. I'm doing this now on Thursday, the 29th of February. You can see there our topic, how to manage greed and fear when trading. So that old saying is that markets are driven by those two emotions, namely greed and fear. So many people want to get rich as quickly as possible, and bull markets obviously provide us the means to do that. But just as the market can become overwhelmed with greed, there also succumb to fear. So these two powerful emotions significantly influence the behavior of traders in the market. And one of the best ways to minimize the impact of these emotions on your trading performance is to develop a comprehensive trading plan. And I'm going to be focusing a lot on that today. So being a successful trader relies on being consistently profitable, and that should be your goal as a trader, to be consistently profitable over the long term. And that requires a good trading plan, and more importantly, the discipline to stick to it. So a well-defined trading plan includes entry, exit, and obviously risk management criteria, which we'll go into more detail later. And the whole idea here is to help you maintain discipline and reduce your emotional decision making. So join me. My name is Sean van den Berg. I'm an investment specialist at PSG Wealth, as I discuss ways to minimize, or to manage your emotions when trading. Okay. So the reason why I've chosen this image today with the dominoes, some of you might have heard. Let me just get the next slide here. Oops, gone too far. You maybe have heard of the saying, the domino effect. The other idea is, in simple terms, it's a reference to a series of standing dominoes, which each one topples the next, creating a chain reaction. So in other words, one event sets off a series of similar, related and connected events. Okay, so the whole thing is just a metaphor for a cause and effect relationship. Now each of us can think of one small act that leads to progressively larger consequences. So the good news is that while we hear primarily of the bad things, the same domino effect is also is true for good things. Okay, so the domino effect holds both positive and negative habits, but you can never change just one behavior. So our behaviors are interconnected. So when you change one behavior, other behaviors also shift. So you can see our little agenda for today, my 3 little topics there. The whole idea today, I want to introduce what I call market or trading psychology. Okay, I hope that makes sense to you guys. So just as a introduction, when I was a naive newbie trader, I didn't pay much attention to my trading psychology. I was more focused on technical charts. My background is I'm a technical analyst, so I was looking at more of the technical chart patterns and the trade setups and things like that. But I soon found out the hard way that obviously ignoring the psychology, ignoring the greed and fear, had a challenge, had an impact on my trading results. So I began to make more serious effort to master my personal trading psychology. So I started obviously reading a lot of trading psychology books. One of the first ones I ever read was Investment Psychology by Martin Pring. There was also one trading in the zone and things like that. There are quite a few, but the whole idea was for me to start understanding market psychology, which paved the way for me to make obviously better success in my trading. But I just wish I'd done this a bit earlier, avoid all those losses I did. So the best way to develop your trading psychology is simply to work your way through hundreds of live trades. We don't offer a trading simulator or anything like that, but start small, but start with real capital. I always find the problem with a trading simulator is that we give you a fictitious amount of 100,000 Rand, you make some money very quickly and you think, oh, this is easy. I call it the cowboy mentality. You go into the market of real money now, and then the voices start talking to you. I call it the voices. That's your emotions. Okay. I've also learned over the years to keep a basic, I call it a trader's journal, and note when I feel these emotions come on. Um, and also just to identify your strengths and weaknesses in that trading psychology. I find it's very useful with hindsight to learn from your mistakes, and also just to obviously to apply to rectify it and apply new rules as such. Okay, so many traders are emotional and reactionary, and obviously that's the big problem there is that fear and greed are the heavy hitters in that arena. So the common sense and self-control is what would provoke any change in the market as such. So, and this is human nature. So when it comes to humans and money, fear and greed are powerful motives. So how can you take advantage of fear and greed in the market? So the whole idea is become a contrarian. Warren Buffett's famous saying is, be fearful when everybody else is greedy, and be greedy when everybody else is fearful. It's exactly the same thing here with savvy traders. You want to buy when the market's oversold, when it's bottomed out, and obviously sell when it's toppish. Um, the idea is to, whenever else is panicking, you want to pick up shares that are on sale, call it that, and then sell when the market's having euphoria, which often leads to bubbles. So at the end of the day, as I said, human nature is a big part of it. It's human nature to be part of the crowd. So it's difficult to go against the crowd. That's the point I'm trying to make here. So yeah, you can see the title there, the topic there, how to manage greed and fear when trading. I've actually learned that actually there's 4 powerful emotions that can affect your trading. So we talk about greed and fear, that's the normal ones. And we also talk about hope and regret. So left uncontrolled, these emotions can have a seriously negative impact on your trading account, but only if you let them. Okay. So the idea here is to master these key emotions, and obviously that will determine your long-term success. Okay. So first of all, we're talking about the dangerous emotion of greed. Um, so it's uh, Yeah, so the whole idea here is most people, I mentioned right in the beginning, most people want to get rich as quickly as possible. I talk to anybody that opens a new share trading account or CFD account of them, asking why did they do it? Yes, they want to make money. Okay. Uh, but the whole idea here is that too much greed decreases your trading profits. And that's what's important here. Greed is excessive desire for money and wealth, uh, although it is a natural human emotion. A healthy amount of greed can help drive your trading profits, but too much greed will do the opposite effect. And that's the point I'm trying to make. So how do you know when it's too much greed? Greed is when you have already made a large profit on a trade, but you're still obsessed on how much more you could have made if you had stayed in a trade longer. And that's a problem. So the mistake is with this reasoning is that all gains are not real until the position is closed. Until then, a winning trade is only a profit on paper. So yeah, I have a challenge of that. When you take the profits as such. The money's in the bank. Greed can also cause traders to make bad trades by ignoring solid risk management trades. We talk management rules. We'll be talking more about it just now. So the idea is it's a lack of discipline in your trading when these things happen. So to keep obviously greed at bay on a winning trade, I suggest that you sell a part of the trade, sell part of the share size or the position size to lock in your profits, and then you move up. You move your stop loss up higher on the rest of the money. Okay, so we'll talk about it in more detail just now. Okay, so Yeah, that makes sense to you guys. Let's talk about fear. Now, this is a very powerful human emotion that affects your trades. Now, we talk about, um, just as the market can become overwhelmed with greed, it can also succumb to fear, as I mentioned right in the beginning. So when shares suffer large losses for a sustained period of time, traders can collectively become fearful of further losses. So they start to sell. We saw that in COVID, when the markets dropped in March 2020. Market dropped. I remember Sassel dropping to 20 Rand and people were panicking big time. Okay. So, the economists have a saying for this, and they call it the herd mentality or herd behavior. Okay. So just as greed dominates the market during a boom, fear prevails during a bust. Okay. So to stem those losses, traders quickly sell those shares, and most of the people, most of the time, they move into cash or they move into the sidelines, and that's it's safe to do that, but a lot of times you miss opportunities also. So as I said, fear is one of the most powerful human emotions. Um, it's a distressing emotion that's caused by a feeling of impending danger. And this can be real or imagined. Okay. So as I mentioned just now, just the main thing is that markets sometimes drop faster than they rise. We say you take the lift. You take the lift upstairs to go higher, and you jump out the window to go down faster. So yeah, it's an old saying in the markets that. So the whole idea also is that sometimes we might experience a string of losing trades, and this is going to be mentally challenging. Um, and the best thing to do there is just to take a bit of a break, review your trading plans, and then come back when you really feel stronger. But one thing I want to highlight here: each trade is completely independent of the previous trade. Don't tie up the losses from the previous trade into the new trade, and try and play catch up. I've tried to do that also when I first started trading more than 25 years ago. I remember my goal was to make 2,000 Rand a day. And those are days before we had derivatives like CFDs and single stocks. We only had equities, even before warrants. So, one day I could only make money when the market was going up. If we had a down day, I did not make money. So now I make 4,000 Rand the next day. And that was dangerous, trying to chase that kind of uh, money. It's much easier now to make money with the derivatives and things like the warrants, going shorts, going with calls and puts. Okay, even with CFDs, going long and short, so it's much easier to make money. But don't chase the money, and that's the point I'm trying to make here. Hope. Now, I always joke, hope is not a trading strategy. This is what I call a fake friend that to take your money, but only if you let it. So it's anticipation or desire for certain things to work. You hope the market will go up today. You hope the market will be a big trading day on the market. And those are things that are dangerous also. It's a very dangerous emotion for traders. So always use a stop, and that's what we'll talk about just now in more detail. So if you don't use a stop, I always say if you pull your stop also, that would lead to bigger losses. You don't want to do that. So sometimes you might have ignored your stop. The market might have dropped. You bought at 10 Rand, now it drops to your 9 Rand level. You pull your stop, now it drops to 8. And now it comes back, and it eventually back to 10 Rand to your entry point. As a lot of people might get out there. So that's what we call a second chance to exit. But you're playing a fire when you try and do that kind of stuff. A weak share continues much lower than before bouncing. You can see there are a lot of examples in the market right now. British American Tobacco, Sassel I mentioned just now. You can talk about MTN. There are a lot of shares that are dropping down, things like that. But what do you do? As long as you have a stop in place, if it goes through your stop, even at these low levels, then your timing was wrong. Maybe get in a bit later. What I suggest is look at your longer term charts. Look at your going back a few years, and then set your stops, your support and resistance levels, or more importantly, the stop levels, and get in those levels. Okay. So the point here is set a stop at a predefined level to obviously to to maximize or to minimize your losses. Okay, and that old cliche: plan your trade and trade your plan. Okay, so I hope that makes sense to you guys also. Let me talk about regret. Now, regret is also a dangerous little emotion in the markets, in the sense that um, you know you're hoping for the next opportunity. Or let me put it this way: always remember that the next opportunity is always around the corner. So regret is basically sadness or disappointment that you've missed a trade, or you got out too early, um, or it involves a loss. You did something stupid and you made a little loss. So those are regrets. Don't do that. What I suggest you do is every day when you close out your trades with your journal or your trading journal, write down the reason for buying a share, write down the reason for closing out, but also evaluate where it went wrong, learn from it, and then obviously apply it, and move on. Don't waste time regretting your decision when to enter the trade and things like that. Train your mind to simply move to the next trading opportunity. Remember, it's independent. There's always a profit around the next corner. I mentioned just now, do not chase the trades with risky entry prices. So, you might have, let's say you plan to buy XYZ share at 60 Rand buy price, okay, what I call a EP, entry price. So you're going to buy at 60 Rand with your target price at 70 Rand. But if you buy it, your initial stop might have been at 55 Rand. That gives you a 1 to 2 risk reward ratio. You're risking 5 Rand to make 10 Rand. But now, say for example, the share rallies. Okay, your original price was 60 Rand and you missed that now. Now you choose to chase the price to at 65 Rand. But, the thing is, if you don't significantly raise your initial stop, you have a negative risk reward ratio of you're risking 10 Rand to make 5 Rand. And that's crazy. So that's what I mean by this here. Okay. So guys, I hope that as a quick introduction to those emotions is helpful to you. Let's talk about some more trading rules. Okay. So as I mentioned just now, anyone who wants to become a consistently profitable trader needs to spend a few minutes online, and you'll find phrases like plan the trade and trade your plan. The other one you'll find also quite often is keep your losses to a minimum. So those are the two ideas that you'll find around, just if you had to Google successful trading. But the 10 rules we're going to discuss here, all of them will help you increase your odds of succeeding in the markets as a trader. So first of all, always use a trading plan. So we'll go into more detail just now, but the idea here is that trading plan is a set of rules, okay, that specifies your entry, your exit, your money management criteria on each trade. Okay, so with today's technology, there's software that can help you back test ideas. So for example, on our Viewpoint trading platform, I suggest, and this is what I've done with technical charts, go back in time and look for the trade setups where would have been a perfect time to get in and out, and back test. So that allows you to test your trading ideas using historical data, and obviously it helps you determine if the trade would be viable. And there's various technical indicators in Viewpoint that help you determine when to get in and out. But the idea is that as you develop your trading plan and back testing it and that to show some good results, and then you use that in real trading. And that's the idea here. Okay, so we'll go into more detail just now with the trading plan. Treat trading like a business, and this is what's important. I just find some people at the outset have the wrong idea. Let me put it this way: you must treat it as a full or part-time business, not as a hobby or a job. With a hobby, if there's no real commitment to learning, number one, and number two, obviously, if you treat it as a job, it's very frustrating because you won't get a regular paycheck. So you're not going to get a regular salary. You're going to put in the hours and get X amount back. But also, if you treat this as a business, realize that there will be expenses in education, there will be losses, there will be taxes, there will be uncertainty, there will be stress, there will be risk. That's how you view it. So as a trader, you're essentially a small business owner, and you must research and strategize to maximize your business potential. Okay, then use technology to your advantage. I already spoken about backtesting charts and things like that. But you know, the charting platforms gives you infinite ways to view and analyze markets. So you can look at different time frames and things like that. And backtesting is the idea that you use historical data that prevents costly mistakes. Okay, hindsight's perfect science, as they say. And then obviously protect your trading capital. Very, very important. So this is when I talk about trading capital. You know, you want to have enough money saved up to fund your trading account, and that does take time. So yes, I suggest minimum of 100,000 rand if you want to become a serious trader. For share trading, we don't have a minimum investment, but you must take into consideration the trading costs. So, our minimum trading cost on equity trading is 265 Rand per trade. That's up to 25,000 Rand. That's excluding the 15% VAT. So with 1,000 Rand, your shares, you need to know that your shares must move up to nearly 26.5% to break even on costs. Okay. So with a single 20,000 Rand trade, your costs will roughly drop down to about 1.32%. But also then you must be mindful that all your you put all your eggs in one basket with one share. So I believe it's much better if you want to be a trader to save up 100,000 Rand, and you can do what we call CFD trading. Number one, it's more capital efficient. So it gives you 6 times gearing. So your exposure to the market is 600,000 Rand, number one. And number two, it's cheaper compared to trading equities. Your brokerage cost is only 0.4% plus VAT. But I'll go into the more detail just now. Okay. So it's important when I talk about protecting your capital. It's important to note to protect your trading capital is not synonymous with never experiencing a losing trade. All traders have losing trades. So when I talk about protecting your capital, it means that you're not going to take unnecessary risks, and you're going to do everything you can to preserve your trading business. So you want to stay in this game for longer. That is your secondary goal. Number one is to be consistently profitable. Number two, to stay in the game as long as possible. Okay. And then become a student of the markets. Okay. I'm a student of the markets more than 30 years, and I love it. I'm still learning about the markets every single day. So as a beginner, you need to learn about technical analysis, or what we call a trading method or methodology. You need to learn more about your mindset. You also learn more about money management. I call it the 3 M's: method, mindset, and money management. But think of this as continuing education. Traders need to remain focused on learning more each day. So the idea is also important to remember to understand the markets and the intricacies that's going on. It's a lifelong process. Markets change. Markets do change, but things also stay the same. Human nature doesn't change much. So the idea is that you can learn a lot about, world politics and news events and economic trends and even the weather all have impact on the markets. So the market environment, put it this way, is very dynamic. So you need to understand the past and current markets to be better prepared to face the future. And that's what I'm trying to point to here with being a student of the market. Okay, rule number 6. We start talking about risk. Only what you can afford to lose. And now we talk about money that I call it being the money in your trading account must be something that is expendable. Another way of looking at it, in the bigger picture of things, it's a small significance. If you had to lose this money, that 100,000 Rand, if you lost it, how would you feel? If it's the end of the day, it's your life savings, maybe you should rather start as an investor. Okay, so it's something that you can't afford to lose, because I can tell you now, you'll have a mental relationship with that money if it's everything. Okay, so understand that trading is risky. That's the point I'm trying to make here. This must not be money that you saved up for your children's education one day, or your home loan or something like that. And also, please do not go take money out of your bond. You know, don't take money, borrow money out of from somewhere to invest or to trade on the markets. Because something goes wrong, you still have to pay that capital back. Okay, do not invest borrowed money. So save up until you got 100,000 Rand starting capital. Then you treat it as a business. Okay, so develop a methodology based on facts. You know, so there's various. I can tell you now. You go into the internet. There are a lot of trading scams on the internet. Be careful. So please do not be in a hurry to learn. Okay, take your time, sift through all the information available on the internet, and then develop call it this way, as you start out your career, you start slowly studying, yeah, markets and things like that. Yeah, if you had to start a new career, put it this way, you need to study at a university for at least a few years to qualify to apply for a position in a new field. Exactly the same thing with trading. It takes the same amount of time and fact-driven research and study. Okay. Always, point number 8 there, always use a stop loss. Okay, it's like your seatbelt. When you climb in your car, you put your seatbelt on. Not because you expect an accident, but just in case some idiot skips a traffic light. Especially with load shedding at the moment, traffic lights aren't working, especially at night. Yeah, yeah, be careful of those kind of things. But the idea of the stop loss is exactly the same thing. So it's what it is a set random amount or percentage, but the whole idea, it limits your exposure to each trade. Okay, and I'll go into more details just now on that. So when to stop trading? You know, sometimes there are two reasons why. Two reasons to stop trading, put it this way. Number one is an ineffective trading plan, and number two, an ineffective trader. So ineffective trading plan shows just greater losses than anticipated with historical backtesting and things like that. So that happens, you know. Markets may have changed and volatility may have lessened. Those are the two big things there. But a trading plan is simply not performing as expected. So your goal is to stay unemotional and be business-like. You know, you need to sit down and reevaluate the trading plan and make a few changes, little tweaks, and then start a new trading plan. Okay. So what's important here is that unsuccessful trading plan is a problem that needs to be solved. Okay. It's not necessarily the end of the trading business. So that's number one. Number two, an ineffective trader. So this comes to you personally. So this is where you're not sticking to the plan. It's a lack of discipline, call it that. Could be external stress, but mainly I find in the past, in my situation, was a lack of discipline. Poor habits, lack of physical activity can also contribute to this problem. You know, if you're not in peak condition for trading, you should consider obviously taking a break. If you're tired, if you had a restless night, I find in the past that I've made some silly decisions when I'm tired. Okay, when I haven't had enough sleep. So all these things, as I say, you need to deal with them. These difficulties and challenges you need to deal with, and then obviously return back to business. And number 10, keep trading in perspective. You know, look at the big picture. You know, a losing trade should not be a surprise to you. It's part of trading. Okay, so if, imagine a whole string of trades. I always use the example of 10 trades. So we'll talk about it just now in more detail with a position sizing. But sometimes you'll be making little losses. So you make 2% loss, 2% loss, 2% loss. Yeah, you make a bigger trade, make a big profit. Might have been a 1 to 2 or 1 to 3, 1 to 4 risk reward ratio. You might make a small little loss. You might make a 5 times profit. You know, sometimes 7 times. So it goes on. But if your overall trading pattern, if you're minimizing your losses to just 2% and you're making big trades, you're doing well. Okay. So remember, a winning trade is just one step to a profitable business. Okay. It's a cumulative profits that make a difference. So your goal, as I said just now, is to be a consistently profitable trader. Okay. So I hope that's made sense to you. So the bottom line of these 10 rules, I just wanted to draw your attention to the risk, number one, and also the potential to lose money. Okay. So remember, the business of trading, you're in the business of making money in the markets. So losses are part of the trade. It's inevitable. It will happen. Okay. But you want to keep those losses small. Cool. So 10 steps to building a winning trading plan. So the idea here, first of all, very quickly, and I know I'm going over time because I always love this topic. Understand a trading plan. The idea is with trading plans, it's built in a variety of different ways. You as a trader will typically customize for your own trading plan based on your own, obviously, personal goals and objectives. But also, it can be lengthy and detailed. I find the more detailed, the better. And the idea here is that a trading plan is just a well thought out research document. It's a roadmap for you that you'll use to call yourself, to prepare yourself for the ups and downs of the market when trading. So that's just a better way. You'll only change it if you find a better way along the way. But the point here with a trading plan, no trades are placed until a new plan is made. Okay, so you can use it as, we'll talk just now about a template, but every trade, before you put on a trade, have a trading plan. Okay, so what is a trading plan? As I mentioned just now, is a systematic method for identifying, number one, what shares you're going to trade, and number two, what shares you're going to trade. Okay, so there's a lot of variables. We spoke just now about time, risk, and traders, your objective. How are you going to find the trades? You're going to create a watch list of potential winners, and then how are you going to tweak it down from there? How large will the trade be? How would you manage the trades when they're open? What shares can be traded? There's a lot of other rules. Again, as I mentioned just now, no capital risk until a trading plan is made. Okay, so that's just some introduction to what is a trading plan. So the thing is, I call it a tactical trading plan, or a detailed trading plan. The idea here is to look and be aware of, excuse me, just get some water here. Exact price levels. That's what I look at. Exact price limits. I call it, there's three things I always look at: the EP, my entry price, my TP, my target price, and my SP, my stop price. I need to know those levels before I even put on a trade. Okay, and there's a lot of other criteria that have to be met. But how would I find a trade? And that's based on we call it a trade setup. It might be based on a chart pattern. I like chart patterns. I trade a strategy called breakouts. I look for shares moving sideways, going through consolidation area. I look for the share to break up above resistance, and that's the kind of things I look at. So you might look at a trending or a trading market. There's various things you look at. You use technical indicators, a lot of other factors you might use in. But also important, as I say, you need to know, when would you get out of position? When would you get out of a trade? Number one, when would I take a profit? Number two, when will I take a loss? Know those levels. Okay, that's why I like to use charts. And the charts, my price action tells me where to place the trades. Okay, I like to use limit orders to take profits. So in other words, with limit orders, I stipulate the price. And same with stop orders. I use contingent stop orders to exit my losses. Okay, so I hope that makes some sense. Let's talk about the 10 steps to building a winning trading plan. So first of all, goal definition. As I said just now, you need to determine what is your financial goal. My main goal is to be as a trader, to be a consistently profitable trader. That is my goal. Okay. My trading style, I'm more of a swing trader. You get day trading. That's someone that doesn't hold a position overnight. Swing trading, I try and get as low as possible and sell as high as possible when the charts show me to do that. I find on average my trades, the time period there is about 12 days. That's my trading style. Some of you might be a bit more longer term, especially with CFD trading allows you to be what we call position traders. So it's more like an active investor, a bit more longer term. You might do 2 or 3 trades a year. If you're very, very conservative, you also might do 2 or 3 trades a month as a position trader. I just find with swing trading a bit more active. My strategy development, this is how you would approach the market. How would you select your initial shares? As I say, with CFD trading, we only try to trade the top 100 stocks. I'm mainly focused on the top 40, the large caps. So there's top 40. Out of those top 40 companies, I can select one bank. I select one insurance company between Sanlam and Old Mutual. I select a mining company. I select a gold company. And so it goes on. But out of those 40 stocks, I might bring it down to about 10. And then I become call it a expert on those 10 companies. I get to know the support and resistance levels and things like that. So I use the charts. I use breakout trades for my entry and exit points. I use the trend lines, and that's how I set up my trading strategy as such. I use technical indicators as a secondary indicators to confirm. I use mainly moving averages and things like that to confirm the trend. I never trade. I never go long with a share trading below a 200-day moving average. That tells me that I should be more on the short side. So I always try and find shares that are trading above a 200-day moving average. That tells me the odds in my favor that long-term trend is up. Okay, but the main thing is that you need to know when to get in, when to get out on profits and on losses. Okay. So yeah, that's all part of the trading strategy. Risk management, we'll go into more detail just now. We talk about risk management, but I'll talk about more money management because there's two parts to it. Position sizing, number one, that tells you how many shares to buy, and your risk management is your stop loss. They fit hand in hand. Okay, and then realistic expectations. I just find that a lot of people want to try to chase quick profits very quickly. They want to be a millionaire by next week Tuesday. It's crazy, don't chase the market. Number one, we spoke about it before, and also never ever, this is not like playing roulette. You put all your money in red and hope. I spoke really about hope being a dangerous strategy. So don't put all your money on one trade. Or risking too much capital per trade. Again, that's why I'm saying start with 100,000 Rand gives you more flexibility as opposed to starting with 10,000 Rand. Okay. And then comprehensive market analysis, I just like to use my charts. I look at what's happening on the indices. I look at the top 40. I look at the whole market, and then break it down from there. I do read the business day to follow out what's happening on the market, why the market moved. Yes, I have the advantage of working in a stockbroking firm, and we do have feedback from the dealers and things like that. But the main thing is you'll get a feeling for the market very, very quickly. Risk management, very, very important. So let's talk about point number 6 here. Sorry, I've got a frog in my throat here again. So to protect your capital, risk management strategies must always be implemented. So it's allocate the percentage of your portfolio for each trade. Now, I like to use, if I had 100,000, if you got 100,000 Rand, for example, I never risk more than 2% per trade. So 2% of 100,000 Rand is 2,000 Rand. I never risk more than 2,000 Rand per trade. So very simply, if I had an entry price of 10 Rand, my target price is 12 Rand. In other words, my target, I want to make 2 Rand per trade. My stop is at 9 Rand. Remember, I'm getting it at 10 Rand. My stop will be at 1 Rand. So my risk reward ratio is 1 to 2. I'm willing to risk 1 Rand. That's the difference between my entry price and my stop. Okay, from 10 Rand to 9 Rand is 1 Rand. Okay, and my profit from 10 Rand to 12 Rand is 2 Rand. So my risk reward ratio is 1 to 2. You should never have a risk reward ratio lower than that. Okay. So your goal is to have 1 to 3, 1 to 4, 1 to 5. Those are ideals. Okay. So if I take my 2,000 Rand, what I'm willing to risk per trade, I divide it by my 1 Rand stop. Okay. So my 2,000 Rand divided by my 1,000 Rand. In this scenario, I can go buy 2,000 shares. Okay. So whatever the shares we're trading at, I know that's how much I can allocate per trade if it's trading at 10 Rand. Okay. So with CFD trading, our minimum exposure per trade is 25,000 Rand. So 15% margin on that is 3,750 Rand. So that'll be your initial margin. So always, and then you work from there, how many shares you can trade. Okay, trade management plan. So the whole idea is that once you got into the trade, you've opened the trade. How would you manage it during the day? Most of you here, I presume, are working full time. So I like to set contingent orders. I'm not watching the market the whole day. I'm not sitting in front of my computer all day. I let the system manage it for me. If the market drops back, cuts me out, that's it. Okay, that's the name of the game. But also, if the market goes up like I anticipated and it hits my target level, my previous example, 12 Rand, I have a set order. If it hits 12 Rand, sell me out. So in other words, that's what I say, we use contingent orders to do that for me. And then you also should determine when to adjust your stop loss orders and take partial profits and exit the trades entirely. So what I do is at night, at the end of the day, I analyze the market and then adjust it from there. So I hope that makes sense for you. Okay, and then trading discipline, your maintenance and things like that, is very important. Plan the trade and trade the plan, and stick to it. This is the main thing: is embrace discipline and consistency when executing exiting trades. And then monitoring and trade evaluation. The main thing here is I like to keep I just old school still. I keep a notebook or what I call a trader's journal. But you also create an Excel spreadsheet. So you want to be able to have a detailed record of your trading activity that includes your entry and your exit points, the reasons for taking the trade, and obviously the outcomes are very essential. So when I say trader's journal, I write down my emotions. I was greedy, I was fearful, whatever the case might be. But also, I write, the idea is with hindsight, I can go review my trades and then learn from it. And that's how you become a better trader. Okay. And then obviously that fits into the last point there with continuous education. We've spoken about it before. Learn from books. There's so much information on the internet. One of my favorite websites is a website called investopedia.com. But there's a lot of other websites you can go learn, and there's free education out there. Okay, just be very careful of people trying to push their trade setups on you. So here's an example of a trend-based trading plan. I just find it very simple. If you follow this, that's a guide to plan a trade. It's a simple flow chart to help you formulate a trading plan very quickly. So before you place the trade, okay, ask yourself, what is the trend? Is the market going up? Is the trend bullish? Do we have higher highs, higher lows? Okay, is it above moving averages, above a 200-day moving average? Is it above a support level, etc.? Or is the trend below 200-day moving average? So in other words, it's bearish, below 21-day and 40-day moving averages. Okay, or is the market moving sideways? Very important that also. So that's why I like to use support and resistance. Those are horizontal lines. I like to color them and make it more visual. So my support level is always red and my resistance level is always blue. So from that, I can say to myself, if it's bullish, is it at support, in other words, at the bottom of the market? If it's yes, then I want to buy. And then I will confirm with my MACD indicator or my stochastic or my RSI indicator. If not, I do not place a trade. And don't try and change the period of the indicator to manipulate it to give you a buy signal. Okay. If it's a sideways market, wait for a breakout. And as I said, this is a strategy I use. I wait for breakouts, especially on a sideways market. What's nice about it is I use the difference in a sideways market. If the share's trading at the high, at the top of the range, it might be at 10 Rand. Bottom of the range is 5 Rand. I know the trading range is 5 Rand. So when it breaks out above 10 Rand, I know my target will be 15. So number one, I know direction. Number two is I have a target price. Okay. And then I'll set a stop just below that 10 Rand level. Okay. So yes, there's the old saying in the market, buy low and sell high. In this scenario, you're buying high and selling high. Yeah. The market's bearish, if it is at resistance, obviously you'd go short or you'd sell. Okay. If not, then don't trade. Okay. So I hope that makes sense to you. Very quickly, gone out a lot of time, gone over time here. But you can see a well-prepared, comprehensive trading plan. There's like 8 criteria that you can look at. Pre-market routine. What do you do before the market opens? I find it's easier to do analysis at night and then confirm in the market what I'm doing. What is the market sentiment? You know, is the market bullish, bearish, cautious, optimistically? You know, that kind of stuff. The technical outlook, and that's where my charts help me in the big time. Risk management, as I mentioned just now, I don't risk more than 2% per trade. I have an Excel spreadsheet. I know exactly, or my notebook, and I know exactly per trade what I'm willing to trade. And I maintain my risk reward ratios. I never ever go below that. Market type, in our scenario, yeah, obviously you can either trade shares. I like to trade CFDs. I focus mainly on the top 40 companies. And of those 40 companies, I might make a smaller watch list of potential winners, especially shares that are moving sideways. So that kind of analysis I do on the weekend. My stop loss, I always set up in advance. That is my, for my charts, I look for a support level and just slightly below that. Okay, my time frame, obviously my different time frames. Most of us will be trading on end of day data. So I use daily time frames. Conditions, you can either trade a trending market, is either trending up or trending down, or the market's moving sideways, what we call a ranging market. So I like to trade a ranging market. I wait for the breakout into a trending market. That's the kind of trades I like to do. So when would I enter a trade? I either use a pullback. You can use a lot of Fibonacci's. You can use breakouts. It's my preferred one. Crossovers of various technical indicators and things like that. And then also, when would you take a profit? You know, do you take all the profit at once? Would you take part of it? Would you put them up? And so it goes on. Okay, so there's various ways, but these guys, I suggest is go Google trading plans, and I suggest go Google trading plan images. You'll find a lot of information on the internet. Okay, so quick summary. Obviously, trading decisions are driven by the 4 powerful emotions. We are mainly, a lot of people focus on fear and greed, but also on focus on hope and regret. Remember, we spoke about those 10 trading rules. They work together to help you increase your odds of success on the market. And then a trading plan is just a well-researched written document that guides you as a trader to make better informed decisions. Okay, and we're going into details now about the trading plan. But the point again, I want to highlight, do not trade until you have a trading plan in place. Okay, so guys, yeah, in conclusion, we've spoken a lot about equities. I suggest maybe consider, if you want to be a serious trader, I suggest maybe consider open up a CFD account. So from my side, there's my contact details. You can contact me on 0860 000 368, or alternatively, you can email me. Okay, but from this point of view, all the information here is just for educational purposes. I hope you've enjoyed this webinar. I know I've gone over time because I get carried away sometimes. But guys, from my side, thank you very much. Until next month, bye for now.